Chapter 7. The Hullabaloo about dividends. There is a considerable degree of twisted thinking and general acceptance of half-truths about a number of aspects of common stock investments. However, whenever the significance and importance of dividends are considered, the confusion of the typical investor becomes little short of monumental. This confusion and acceptance of half-truths spreads over even to the choice of words customarily used in describing various types of dividend action. A corporation has been paying no dividend or a small one. Its president requests the board of directors to start paying a substantial dividend. This is done. In speaking of this action, he or the board will often describe it by saying that the time had come to do something for stockholders. The inference is that by not paying or raising the dividend, the company had been doing nothing for its stockholders. This could possibly be true. However, it certainly was not true just because no dividend action had been taken. It is possible that by spending earnings not as dividends but to build a new plant, to launch a new product line, or to install some major cost-saving equipment in an old plant, the management might have been doing much more to benefit the stockholder than it would have been doing just by passing these earnings out as dividends. No matter what might be done with any earnings not passed on as dividends, increases in the dividend rate are invariably referred to as favorable dividend action. Possibly with greater reason, reduction or elimination of dividends is nearly always called unfavorable. One of the main reasons for the confusion about dividends in the public mind is the great variation between the amount of benefit, if any, that accrues to the stockholder each time earnings are not passed on to him but retained in the business. At times he is not benefited at all by such retained earnings. At others he is benefited only in a negative sense. If the earnings were not retained, his holdings would decrease in value. However, the retained earnings in no sense increase the value of his holdings, therefore they seem of no benefit to him. Finally, in the many cases where the stockholder benefits enormously from retained earnings, the benefits accrue in quite different proportions to different types of stockholders within the same company, thereby confusing investor thinking even more. In other words, each time earnings are not passed out as dividends, such action must be examined on its own merit to see exactly what is actually happening. It might pay to look a little below the surface here and discuss some of these differences in detail. When do stockholders get no benefit from retained earnings? One way is when managements pile up cash and liquid assets far beyond any present or prospective needs of the business. The management might have no nefarious motive in doing this. Some executives get a sense of confidence and security from steadily piling up unneeded liquid reserves. They don't seem to realize they are buttressing their own feelings of security by not turning over to the stockholder wealth which he should be entitled to use in his own way and as he sees fit. Today there are tax laws which tend to curb this evil so that while it still occurs, it is no longer the factor which it once was. There is another and more serious way in which earnings are frequently retained in the business without any significant benefit to stockholders. This occurs when substandard managements can get only a subnormal return on the capital already in the business, yet use the retained earnings merely to enlarge the inefficient operation rather than to make it better. What normally happens is that the management, having in time built up a larger inefficient domain over which to rule, usually succeeds in justifying bigger salaries for itself on the grounds that it is doing a bigger job. The stockholders end up with little or no profit. Neither of these situations is likely to affect the investor who follows the concept discussed in this book. He is buying stocks because they are outstanding and not just because they are cheap. Managements with inefficient and substandard operations would fail to qualify under our 15 points. Meanwhile, managements of the type that do qualify would almost certainly be finding uses for surplus cash and not just piling it up. How can it happen that earnings retained in the business can be vitally needed yet have no possibility of increasing the value of the stockholder shares? This can occur in one of two ways. One way is when a change in custom or public demand forces each competitive company to spend money on so-called assets which in no sense increase the volume of business, but which would cause a loss of business if the expenditure had not been made. A retail store installing an expensive air conditioning system is a classic example of this sort of thing. After each competitive store has installed such equipment, no net increase in business will occur, yet any store which had not met the competitive move might find very few customers on a hot summer day. Since for some strange reason our accepted accounting system and the tax laws which are based on it make no differentiation between assets of this type and those which have actually increased the value of the business, The stockholder frequently thinks that he has been badly treated when earnings have not been passed out to him, and yet he can see no increase in value coming to him from what was retained in the business. The other, and even more important way that retained earnings fail to produce increased profits results from an even more serious failure of our accepted accounting methods. In our world of rapid and major changes in the purchasing value of our money units, standard accounting proceeds as though the dollar were a fixed unit of value. Accountants say this is all accounting is supposed to do. This may very well be true, but if a balance sheet is supposed to have any relationship to the real values of the assets described thereon, the confusion that results seems about parallel to what would happen if engineers and scientists made their calculations in our three-dimensional world by using only two-dimensional plane geometry. The depreciation allowance in theory should be enough to replace an existing asset when that asset is no longer economically usable. If the depreciation rate were properly calculated and the replacement cost of the asset remained unchanged over its useful life, this would happen. But with ever-rising costs, the total accumulated depreciation is seldom enough to replace the outmoded asset. Therefore, additional sums must be retained from the earnings merely to make up the difference if the corporation is to continue to have what it had before. This type of thing, while affecting all investors, usually affects holders of growth companies less than any other class. This is because the rate of acquiring new capital assets as against merely replacing existing and about to be retired assets is usually so fast that more of the depreciation is on recently acquired assets installed at somewhere near today's values. A smaller percentage of it is for assets installed years ago at a fraction of today's costs. It would be repetitious to go into detail concerning the cases where retaining earnings for building new plants and launching new products has proven of spectacular advantage to investors. However, consideration of how much one type of investor benefits in relation to another is worthy of careful consideration for two reasons. It is a matter about which there is always misunderstanding throughout the financial community. It is also a matter the proper understanding of which provides an easy key to evaluating the real significance of dividends. Let us examine these misconceptions about who benefits most from dividends by taking a fictitious example. The well-managed XYZ Corporation has had a steady growth in its earnings over the last several years. The dividend rate has remained the same. Consequently, whereas 4 years ago it took 50% of earnings to pay the dividend, so much additional earning power has developed in these 4 years that paying the same dividend now requires only 25% of this year's earnings. Some directors want to raise the dividend. Others point out that never before has the corporation had so many attractive places to invest their retained earnings. They further point out that only by maintaining rather than raising the rate will it be possible to exploit all the attractive opportunities available. Only in this way can the maximum growth be attained. At this point, a lively discussion breaks out as to what course to follow. Someone on this fictitious board of directors is then sure to state one of the financial community's most common half-truths about dividends. This is that if the XYZ Corporation does not raise its dividend, it will be favoring its large stockholders at the expense of its small ones. The theory behind this is that the big stockholder is presumably in the higher bracket. After paying taxes, the big stockholder can retain a much smaller percentage of his dividends than the small stockholder. Therefore, he does not want the increased dividend, whereas the small stockholder does want it. Actually, whether it is more to the interest of any individual XYZ Corporation stockholder to have the dividend raised or to have more funds plowed back into the growth depends upon something quite different from the size of his income. It depends upon whether or not each stockholder is at the point where he is putting any part of his income aside for additional investment. Millions of stockholders in the lower income brackets are handling their affairs so that each year they put something, no matter how little, aside for additional investment. If they are doing this and if, as is likely to be the case, they are paying income tax, it is a matter of elementary arithmetic that the board of directors would be acting against their interests by raising the dividend at a time when all these worthwhile opportunities are available for using retained company earnings. In contrast, the raised dividend might be to the interest of a big stockholder who had urgent need of additional funds, a contingency not entirely unknown to those in high tax brackets. Let us see just why all this is so. Almost anyone having enough surplus funds to own common stocks will probably also have enough income to be in at least the lowest tax bracket. Therefore, once he has used up his individual dividend exemption of $50, even the smallest stockholder will presumably have to pay as tax at least 20% of any additional income he receives as dividends. In addition, he must pay a brokerage commission on any stock he buys. Because of odd lot charges, minimum commissions, etc., these costs run to a much larger percentage of the sums involved in small purchases than in large ones. This will bring the actual capital available for reinvestment well below 80% of the amount received. If the shareholder is in a higher tax bracket, the percentage of a dividend increase which he can actually use for reinvestment becomes proportionately less. There are, of course, certain special types of stockholders such as universities and pension funds that pay no income tax. There are also some individuals with dividend income less than the $50 individual exemption, although the total number of shares owned by this group appears to be small. For these special groups, the equation is somewhat different. However, for the great majority of all stockholders, regardless of size, there is no avoiding this one basic fact about dividends. If they are saving any part of their income rather than spending it, and if they have their funds invested in the right sort of common stocks, they are better off when the managements of such companies reinvest increased earnings than they would be if these increased earnings were passed on to them as larger dividends which they would have to reinvest themselves. Nor is this advantage, having 100% of such funds put to work for them in place of the smaller amount that would be available after income taxes and brokerage charges, the only one the stockholders get. Selecting the right common stock is not an easy or simple matter. If the company considering the dividends is a good one, the investor has already wisely done his task of selection. Therefore, he is usually running less risk in having this good management make the additional investment of these retained extra earnings than he would be running if he had to again risk serious error in finding some new and equally attractive investment for himself. The more outstanding the company considering whether to retain or pass on increased earnings, the more important this factor can become. This is why even the stockholder who does not pay income tax and who is not spending every bit of his income finds it almost as much to his interest as to the interest of his tax-paying counterpart to have such companies retain funds to take advantage of worthwhile new opportunities. Measured against this background, dividends begin to fall into true perspective. For those desiring the greatest benefit from the use of their funds, dividends begin rapidly to lose the importance that many in the financial community give them. This is as true for the conservative investor going into the institutional type growth stock as for those willing and able to take greater risks for greater gain. The opinion is sometimes expressed that a high dividend return is a factor of safety. The theory behind this is that since the high-yield stock is already offering an above-average return, it cannot be overpriced and is not likely to go down very much. Nothing could be farther from the truth. Every study I have seen on this subject indicates that far more of those stocks giving a bad performance price-wise have come from the high dividend-paying rather than the low dividend-paying group. An otherwise good management which increases dividends and thereby sacrifices worthwhile opportunities for reinvesting increased earnings in the business is like the manager of a farm who rushes his magnificent livestock to market the minute he can sell them rather than raising them to the point where he can get the maximum price above his costs. He has produced a little more cash right now, but at a frightful cost. I have commented about a corporation raising its dividend rather than about it paying any dividend at all. I am aware that while the occasional investor might not need any income, nearly all do. It is only in rare cases, even among outstanding corporations, that the opportunity for growth is so great that the management cannot afford to pay some part of earnings and still, through retaining the rest and through senior financing, obtain adequate cash to take advantage of worthwhile growth opportunities. Each investor must decide in relation to his own needs how much, if any, money to put into corporations with such abnormal growth factors that no dividends whatsoever are justified. What is most important, however, is that stocks are not bought in companies where the dividend payout is so emphasized that it restricts realizable growth. This brings us to what is probably the most important but least discussed aspect of dividends. This is regularity or dependability. The wise investor will plan his affairs. He will look ahead to what he can or cannot do with his income. He may not care about immediately increasing income, but he will want assurance against the decreased income and unexpected disruption of his plans that this can cause. Furthermore, he will want to make his own decisions between companies which should plow back a great part or all of their earnings and those that may grow at a good but slower rate and need to plow back a smaller proportion. For these reasons, those who set wise policies on stockholder relations and those who enjoy the high price-earnings ratios for their shares which such policies help bring about, usually avoid the muddled thinking that typifies so many corporate treasurers and financial vice presidents. They set a dividend policy and will not change it. They will let stockholders know what this policy is. They may substantially change the dividend but seldom the policy. This policy will be based on the percentage of earnings that should be retained in the business for maximum growth. For younger and rapidly growing companies, it may be that no dividends at all will be paid for so many years. Then when assets have been brought to the point where the depreciation flowback is greater, from 25 to 40% of profits will be paid out to stockholders. For older companies, this payout ratio will vary from company to company. However, in no case will the rough percentages govern the exact amount paid out. This would make each year's dividend different from that of the year before. This is just what stockholders do not want, since it makes impossible independent long-range planning on their part. What they desire is a set amount approximating these percentages and paid out regularly, quarterly, semi-annually, or annually, as the case may be. As earnings grow, the amount will occasionally be increased to bring the payout up to the former percentage. This, however, will only be done when A. funds are otherwise available for taking advantage of all the good opportunities for growth that the management is uncovering, and B. there is every reason to believe that this new regular rate can be maintained from this time on after allowing for all reasonable probabilities of a subsequent downturn in the business or the appearance of additional opportunities for growth. The managements whose dividend policies win the widest approval among discerning investors are those who hold that a dividend should be raised with the greatest caution and only when there is great probability that it can be maintained. Similarly, only in the gravest of emergencies should such dividends be lowered. It is surprising how many corporate financial officers will approve the paying of one-shot extra dividends. They do this even though such unanticipated extra dividends almost always fail to leave a permanent impact on the market price of their shares, which should indicate how contrary such policies are to the desires of most long-range investors. No matter how wise or foolish a dividend policy may be, a corporation can usually in time get an investor following which likes the particular policy, provided that the corporation follows the policy consistently. Many stockholders, whether it is to their best interests or not, still like a high rate of return. Others like a low rate. Others like none at all. Some like a very low rate combined with a small regular annual stock dividend. Others do not want the stock dividend, preferring the low rate by itself. If a management selects one of these policies in line with its natural needs, it usually builds up a stockholder group which likes and comes to expect the continuation of such a policy. A wise management wishing to obtain investment prestige for its stock will respect that desire for continuity. There is perhaps a close parallel between setting policy in regard to dividends and setting policy on opening a restaurant. A good restaurant man might build up a splendid business with a high-priced venture. He might also build up a splendid business with an attractive place selling the best possible meals at the lowest possible prices. Or he could make a success of Hungarian, Chinese, or Italian cuisine. Each would attract a following. People would come there expecting a certain kind of meal. However, with all his skill, he could not possibly build up a clientele if one day he served the costliest meals, the next day low-priced ones, and then without warning served nothing but exotic dishes. The corporation that keeps shifting its dividend policies becomes as unsuccessful in attracting a permanent shareholder following. Its shares do not make the best long-range investments. As long as dividend policy is consistent so that investors can plan ahead with some assurance, this whole matter of dividends is a far less important part of the investment picture than might be judged from the endless arguments frequently heard about the relative desirability of this dividend policy, or that the large groups in the financial community that would dispute this view fail to explain the number of stocks that have offered no prospect of anything but below average yield for years ahead, yet which have done so well for their owners. Several examples of such stocks have already been mentioned. Another typical investment of this type is Rohm and Haas. This stock first became publicly available in 1949 when a group of investment bankers purchased a large block held by the alien property custodian and reoffered it publicly. The public offering price was $41.25. At that time, the stock was paying only $1 in dividends, supplemented by stock dividends. Many investors felt that in view of the low yield, the stock was unattractive for conservative investment. Since this date, however, the company has continued to pay stock dividends, has raised the cash dividend at frequent intervals, although the yield has remained very low and the stock has sold at well over $400. The original owner of Rome and Haas has received stock dividends of 4% each year from 1949 through 1955 and 3% in 1956, so his capital gain has been well over tenfold. Actually, dividend considerations should be given the least, not the most, weight by those desiring to select outstanding stocks. Perhaps the most peculiar aspect of this much-discussed subject of dividends is that those giving them the least consideration usually end up getting the best dividend return. Worthy of repetition here is that over a span of 5 to 10 years, the best dividend results will come not from the high-yield stocks but from those with the relatively low yield. So profitable are the results of the ventures opened up by exceptional managements that while they still continue the policy of paying out a low proportion of current earnings, the actual number of dollars paid out progressively exceed what could have been obtained from high-yield shares. Why shouldn't this logical and natural trend continue in the future?